Hi, friends. Welcome back to the Wall Street Skinny. I'm Jen.
I'm Kristen.
And this is our first of two kind of back-to-back episodes where we're going to be talking about operations. And no, not operations like what happens in back office and how, payments get cleared at investment bank, but operations in terms of how you actually run companies. And Kristen and I are running a company. So we went and read a book that I think we found just absolutely inspiring and life-changing that we read to figure out how to run our own company. And we were so moved by the lessons in this book that we were like, we got to bring one of the authors on to actually talk about it. But before we get to that, after we record this episode, we will be recording what is effectively part 2 of this episode with a very special senior partner at a giant private equity and private credit firm called Sixth Street, who handles go-to-market for companies within their portfolio. So we're going to talk about operations when it comes to growing the value of a portfolio company within a private capital firm's portfolio. So that's how this 1-2 punch of these episodes is going to function. But before we get to any of that, there's so much going on in the markets. We didn't have time to do a proper The Skinny on Newsy episode this week. So a couple of things we want to touch on just really quickly before we get into the meat and potatoes of this episode. Kristen, I'm going to let you kick us off here with what's been going on your radar.
Well, yeah, I mean, this is sort of still almost like a continuation of what we talked about last week with First Brands. So First Brands is one of the auto companies that is essentially going through a Chapter 11, which is a restructuring. That's not the exciting part. The main thing is that they had a failed refinancing, and it spooked the credit markets due to some questionable accounting practices and all this kind of fun stuff. And then yesterday, there was some additional shakiness in the credit market.
Tricolor, So we had two. Basically, we got the third domino in a series that have fallen in terms of things showing stress in the credit markets.
Exactly. Yes. So basically, there were the two bankruptcies in the auto sector, one in which was a Chapter 7, which means that Tricolor, I keep pronouncing it the wrong way, is liquidating their assets. And so all the investors who had lent money are basically taking hold of the collateral, and again, the company is being liquidated. Then you have First Brands, where they tried to refinance $6 billion of debt that they had coming due basically this summer, and they ultimately were not able to because of this these questionable accounting practices related to the underlying collateral, meaning the lenders, if anything were to go wrong, what are they actually going to potentially be able to take hold of, right, in the case of a bankruptcy or, again, Chapter 7.
Multiple people thought they had claims on the same finite group of assets.
Exactly. And so that was obviously spooking the credit markets. We had that conversation last week about private credit and the exposure that Jefferies has and UBS and blah, blah, blah.
Well, spooking the markets, by the way, credit spreads didn't budge.
Did they really?
Going nowhere, right? Everything's still at all-time tights. What we've been waiting for basically is some giant glaring red alert for credit spreads to widen out. And the question is did we get it yesterday afternoon?
Well, yeah. So then yesterday there were two banks. So Zion's disclosed that it had a $50 million write-off that was linked to a fraudulent loan. And then Western Alliance was another bank, also revealed that they had this exposure. But basically what it's showing is that there's fraud and just crazy with the First Brands. It's more accounting shenanigans. Is it fraud? Is it not fraud? Is it kind of okay, but also it shouldn't be okay? It's one of those things.
That's not okay to me at all. But
no, I don't think it's actually okay.
Expert.
Yeah, I don't think it's actually okay. So what ultimately happened is that the lenders asked for what's called a quality of earnings report. So for Deloitte, obviously one of your big 4 accounting firms, to come in and put together a quality of earnings report to be what exactly is actually going on behind the scenes. They were actually audited by some smaller, lesser known, whatever accounting firm, but they wanted to bring in Deloitte. And then ultimately they were not able to go through because they weren't able to get enough of the second lien lenders to participate in the refinancing. But again, it's we talked about this last week, because there was so much easy money and people were starting to get so lax about well, I want a little more yield. Again, credit spreads are all time tights. People want to have some yields. So they were starting to get more and more lenient. And then all of a sudden it's oh shit, there's fraud here. There's some accounting shenanigans there. And so that's what is almost like shaking the markets is like, yes. And you had sent me this Bloomberg article that was like, should we be happy that it's just fraud and it's, you know, it's not a structural thing, but it's like, but also the fact that like this fraud is getting through, I think is maybe a little bit structural. So
that's exactly right. Think about Madoff, right? How many people were just like going through life blissfully unaware that Bernie Madoff was running a $50 billion Ponzi scheme? Well, would he have gotten away with it if the markets hadn't collapsed? I think the answer is no. Like eventually that was all coming down, you know, that was all going to end in tears. But where we are now, we're seeing more frauds be discovered. And is it because it's just like, we're getting lucky and people are discovering frauds? No, right? It's like there has to be some catalyst for these frauds to get discovered. It's usually when something goes wrong or, you know, you have to pay the piper or whatever. So I think it's such an elegant way of putting it. It's like, is it a good thing that it's just fraud? Or is the fraud, in fact, the canary in the coal mine that there is systemic risk? I think this is the big question that we've been asking now collectively for a year. And the question is the private credit market overheated? Is there secretly this stress in the system? And I think what's funny is everyone almost has the foregone conclusion that yes, we just need someone to prove us right. But if you've been short credit spreads this whole time, like you're dying, right?
But
like you just like, or if you've been short equities, right? Like if you have been short risk assets, you just good luck to you. It's just been a disastrous trade. You haven't been able to fight this one-way trade tighter in credit spreads and higher in equity valuations. So like, you know, we think back to 2008 and all the lessons we learned. We had Steve Eisman on the podcast, and you think about owning credit default swaps, right? Well, what's the negative carry on that trade? That wasn't a positive carry trade. You had to pay to hold those positions.
Yeah.
But you didn't have to pay a ton.
Yeah.
You didn't have to pay a lot to hold those positions.
Yeah.
So the question is how expensive is it for you to play for things to get worse at this point? It's not cheap.
Yeah.
So how do you do it? What's the right expression so you don't get carted out?
Yeah. Well, I was going to say, I mean, that was actually the other thing that someone had reached out to us and was like, wait, was Apollo a lender in the First Brands saga? Like, were they, because I mean, Apollo was big in private credit. And the answer was no. Like they basically had bought CDS on the credit. And it was also interesting because like they were essentially like blacklisted by First Brands. Like First Brands didn't actually want them to be a lender. So they were not allowed to like lend to them. And so this was something that I wasn't like as familiar with, but I guess a lot of companies can have like disqualified lenders list, which is
how often does that happen? Like, can you imagine being like, I'm going to buy a house. By the way, JP Morgan, don't you dare try to lend me money. Like,
well, but I mean, like it actually makes a lot of sense. And this goes back to the podcast that we did where we read Sajid Indep's book, The Caesar Palace Coup, and Apollo was actually an equity owner, right, of Apollo, but still when it went through this restructuring, Apollo got very aggressive in terms of like essentially trying to disenfranchise the lenders. And so I do think that they have made a little bit of a name for themselves, right? Like with the, you know, they're going to like elbow, like they DGAF and they're going to be as aggressive as can be. And so I think that honestly, maybe this is a little bit of a sign that like the First Brands knew that they might have to go through a restructuring at some point because what they don't want.
What a crazy process to be like, I don't want you guys involved.
When I potentially have to go through a bankruptcy. But there's other reasons why they sometimes will do that. And actually Apollo is an investor in Tenneco, which is another rival to First Brands in the auto space. And so if they were if they were a lender, they would then also get access to like the data room and they would have the confidential information about First Brands, which First Brands didn't necessarily want. So it could be because like they owned a competitor. It could also be because they were worried about what Apollo might do if they were involved in restructuring. But so anyway, so Apollo kind of was like sniffing out that there was some potential issues. So they bought CDS and started to bet against First Brands. And I think it was a year ago because I believe they potentially...
Was it that they sniffed out issues or was it, I mean, because also when you buy a company CDS, you widen out their credit spreads, right? So like it becomes a self-fulfilling prophecy, right? If you're this great company and someone buys your CDS, but you're so amazing, right? Like, okay, it might put upward pressure on your credit spreads momentarily, but like it'll correct.
Yeah.
I mean, So like, which happened first, right? Was it a crappy company? And then Apollo was like, oh, I'm glad we're not involved in your deal. Thanks for putting us on your blacklist.
That's a good
And by
point.
the way, we want to take a negative view on your credit. Or was it like, oh, you don't want us involved in your deal? We're going to buy up all your CDS, push your credit spreads wider, make it more expensive for you to borrow. Therefore, when you go to refinance, it's going to be harder.
Yeah, that's another point. Like, which came first, the chicken or the egg?
Which came first, the CDS or the egg? Yeah, exactly.
Yeah, the CDS or the egg. But yeah, I mean, I think that was something that I always talked about in like the 2008 financial crisis, where it was like, you could like hurt a company by, buying CDS and like shorting. And that was something that you saw people do in the 2008 financial crisis. And again, I was sitting at Morgan Stanley and people were like pissed off because you would see all these like traders who were freaking shorting the stock and then buying the CDS. And the joke was like, you're buying, it's like buying your insurance on your neighbor's house and then driving your car through it. So yeah, I'm with you on that like, yeah, what came first, the CDS or the chicken or the egg or however the thing goes. So by the way, if you want more of a deep dive into the First Brand saga and the CDS mechanics and all that, we are going to be writing about this in our newsletter. But so anything else, Jen, on the First Brand stuff or like the CDS or anything like that?
No, I mean, if you bought our course, our fixed income course at pre-sale, the first 10 videos of the fixed income derivative, so part 2, launched on Wednesday night. So those are now available. And the last several videos, which are fixed income options and specifically swaptions, Kristen's favorite word that she thought was made up when we first started.
It is made up.
We've got credit derivatives. So CDS, we're going to do intro to CDS before we actually talk about like trading bonds on asset swap and things like that. We've also got mortgages. We've got our FX primer. And all that fun stuff that'll be launching before the end of the month. So anyone who's been waiting for those modules, they are dripping out, and I'm just really excited about that. And then part 3 will be next month. But yeah, no, so I think, listen, the conversation that we have today, switching gears a little bit, but I think it's more, listen, when people talk about private equity firms buying companies, we talk so much about the financial engineering aspect of it. And so much of what actually happens is running these companies, growing these companies, changing these companies. And it's very different too, depending on where you are in the trajectory of a company's life cycle. So for us, we wanted to share the lessons, the operational lessons that we learned that we are now in the process of implementing ourselves. Because if you are someone, we know that so many people who listen to our podcast are not just people who are like, oh, I am in the financial sponsors group of an investment bank, or I'm working in a private equity firm. So many of you run your own companies. So many of you work at companies and have that ownership mentality and are trying to understand how to make your company better. This is a actual technique that is taught at MIT Sloan Business School. So reading this book was kind of like an MBA in a bottle. So that was really cool for me. But the second thing is there is so much more to investing in companies than just being on the deal team, than just how much is this company worth when I buy it and how much is it worth when I sell it. There's that entire process that happens in between. So that's why it's so important to talk about these things. We're literally talking to someone who was on the factory floor at Harley-Davidson making motorcycles. And how apropos when we're talking about First Brands and Tricolor and their steering wheels and their auto parts and things like that. So it couldn't be more timely, because another question that we're going to talk about later today is, okay, if all this fraud is happening at these companies, how do you know if a company is being well run or not? What are the je ne sais quoi things that you need to be able to identify as an operator going into these businesses? And what do you need to know about those things, by the way, also as an investor? Because so many investors don't think about what they need to know on the operational front. They're just like, EBITDA, leverage ratio, blah, blah, blah.
Like, let's just increase the margins a little bit. Like, what does that actually mean? What does that actually take? And by the way, I want to like make one other point, right? I worked in financial sponsors, and there was this joke back in the day, which was like, if you're working in investment banking, it's basically like you are having a one-night stand, right? Like you're working on something, but then you don't, like, the deal's done and like it's not your problem anymore. If you're in private equity, it's like you're getting married. Now, I always like to joke with the intent to divorce in 5 to 7 years, but still, you are getting married. So by the way, you have to, have your prenup. No, but like you need to have your like exit strategy in mind. But so much of the IRR, of the value creation in a private equity deal, in the whole like investment, is growing the operations of the business. And you actually see this whenever I used to teach like LBO modeling, you can do an exercise where you're like, let's assume that like you basically, your EBITDA stays the same. Okay, you look at what your return is. Now all of a sudden, like what happens when you grow EBITDA, it's not only going to be like increasing your the valuation of the firm, it's also increasing the cash flows, which is paying down the debt. So like literally the most important thing you can do when you buy a business is you need to be able to grow the valuation. But also like those little margins, like the little, I'm just going to bump up the growth rate. I'm going to do this. Like, cool. That's nice. How are you actually going to do it? Like, then it comes down to the brass tacks. And that is the most, I would argue, important thing. So I agree with you that this was so interesting for me because I used to joke that like I wanted to go back to business school in theory, but like I could never justify it because so much of what I learned in banking is what was taught in business school. And while that's true, what I didn't know shit about was the operation stuff, which by the way, like now like you and I are
part.
The business part,
the actual
which
business
is
part of the
critical.
MBA.
And so again, for us being able to have these conversations with people like Don, and then later what we're having this afternoon with Paul, who's like we said, the go-to-market operating officer at 6th Street, is so interesting for us because it's just something that we never stopped to think about that much, but it's just so critical.
Yeah. No, awesome. Well, let's bring on Don. We're so excited to have this conversation. The name of his book is called There's Gotta Be a Better Way. And truly, if you were to sum up in one phrase what running the Wall Street Skinny has been like, that pretty much sums it up. Everything we're doing, we're like, this can't be the right way to do this. There must be a better way. So we've learned so much. This is like a pet passion project of ours that it just so happens has like these massive applications. And that's why we're like, we got to make this into a whole episode, and it's taken on a life of its own. So we're excited for these to go back to back, and let's bring Don on.
Awesome. All right. So we are so excited to be joined today by Don Kieffer, who recently published a book called There's Got to Be a Better Way, which we're going to talk about in a minute. But he is a senior lecturer at MIT Sloan, the founder of Shift Gear Work Design, and has been traveling all around the world for over a couple of decades, essentially consulting on optimizing the work processes, the workflows for various companies. And so Jen and I were talking actually before we hopped on about how this book has actually semi-changed our life in the sense that I always used to say that I wanted to go to business school, but like I never saw the point because I knew all the finance. And one of the things obviously you learn in business school is the operations. And so obviously we have no idea how to do anything operation-wise. And people who are interested in working in different types of parts of the industry, specifically like private equity, so much of the value creation when a private equity firm buys a business is actually improving the operations. And so we thought this would be such an amazing opportunity to sit down and talk to you about basically like, how do you think through optimizing work processes for companies, and how can you actually create value, and how do companies get stuck, and all that kind of fun stuff.
Yeah, I'd love to get to the 5 principles that you outline in the book, because taking a step back, we are a very small startup. So it's funny, when I first started reading this book, I was like, well, this is for giant corporations. This is for corporations with factory floors. This is for whatever. When we started our business, we read The Lean Startup because it's like, we're a startup. We want to stay lean. We're completely self-funded. And I can sum up that book as Ross from Friends saying, pivot, right? It's, hey, somebody just learn to pivot. Okay, great. Reading your book, when I first started out, I was like, I don't know what this is going to teach me. This is going to teach me from the eyes of, like Kristen said, a private equity investor thinking about turning around a big company. But this doesn't apply to me. And 5 pages into the book, I called Kristen and said, we need to have a call this afternoon because this is totally revolutionizing the way that I think about our business. And it was through the framework of these 5 principles that you outline and this dynamic work model that totally shifted how I thought about what we are doing, because we are both the factory floor and management, right? We are doing everything because it's just the two of us. We've only just recently made our very first hire. And so it's easy for us to implement these changes because we don't have to run it through 10 layers of management. It's just like, hey, Kristen, you agree? We're going to do it tomorrow. So I think it was actually really interesting using us almost as a case study because we're so different from the average company that you talk about in your book. And you can see just how quickly, I mean, we're 48 hours out from reading this book, and we've already implemented 10 new strategies, and we're both like bouncing off the walls with excitement. I'm dead serious. So I'd love if you can walk through these principles. I feel like I sound like I'm like selling snake oil. I'm dead serious. This has completely changed our day-to-day lives in 48 hours. I'd love if you could walk through these 5 principles and explain this dynamic work model and what it means.
Yeah.
So the concept we have has 2 parts to it. One is the 5 principles, which I'll go through quickly. And the other is the approach, which is like start small. Don't start with these big initiatives. Go like pick a small piece of a big problem and go actually understand what's happening and fix it. And then go to the next one, to the next one. These big initiatives actually do not work because most of the time in a big organization, the top managers don't really understand how the work is getting done. They think they know, like finance does this and manufacturing does that, marketing does that, but they don't really know how a piece of work travels through the organization from person to person. So they make these big programs. It just kind of layers on more and more dysfunction. It doesn't really solve the problems that people have in trying to get through the dumb bureaucratic mess of getting work done every day. But leaders think they have to do these big projects. So that's kind of one of the big barriers. But that's what we're actually doing is doing that with the idea of how we design work and the approach to go start small and go figure it out. So the 5 principles. The first one is solve the right problem and solve it the right way. The more experienced you are, the more kind of patterns of solutions you have in your head. So you're like, oh, I know how to do that. I know how to do that. And that part of your brain, that pattern matching part of your brain, like in Kahneman's book, Thinking Fast, Thinking Slow, that thinking fast is always shouting you, let me help you, let me help you. Yeah. But if you listen carefully, those problem statements are usually solutions in disguise. Oh, the problem is IT needs a new program. Or the problem is the salespeople need more training. Those are all solutions. But why can't the salespeople meet their targets? Let's go talk to them and figure out what the barriers are. Many times you'll find out it's you. Too many meetings, too many bureaucratic pieces. Or why isn't the new product getting out on time? So that's the first thing is get that problem statement clear and then use structured problem solving. There's many of them around. Just plug in A3 in your computer. You'll get like 10,000 hits on the 1-page problem solving structured piece. But the reason those all work because they force you to write the problem down. And when you do that, it pushes it up into the logical part of your brain. Now you treat it like an experiment instead of like, oh yeah, I know how to do that and jump to solutions. So that's experimentation is a big piece of it. So that's the first one. Solve the right problem, solve it the right way. Okay, keep going.
Yeah, I'd love if we could also get into some of the stories that help illustrate, because I think when we're talking in these broad strokes, and I can give examples of how we would apply this in our industry, or you have such colorful examples in the book, right? So for example, you've got the hotel manager who says, I'm not getting enough email capture, right? And so identifying that problem and asking the right question about the problem, it's like, okay, I just invested $3 million in a steak restaurant and I'm not getting enough covers sold. Okay, well, that's the problem that every business has. You're not selling enough, right? But it's okay if I get this email capture and I identify this very tiny problem, how you execute on that. So I'd love if you could use some of the stories to illustrate. Because
I'll finish that story for you because the other problem he had was they invested in a brand new restaurant and they weren't getting enough traffic in it. So he figures, well, like maybe the people at the front desk need training, which we said no. We said you have to go work at the front desk and visit with those people, and that's what he did. He spent a couple of days there watching what they did. And what he found out was that, first of all, people are learning all the time. So if someone came in late at night, was really tired, someone got good at, let's get you to your room quickly. But every person at the front desk was learning their own little set of rules based on what happened to them personally. And of course, the other managers are saying, hey, you have to plug the shuttle bus, or hey, you have to plug the movie theater. And so they have all these demands coming on them when really what the corporation really wants is primarily email capture and direct people to the restaurant. So he goes and watches them. And then what they started doing was they turned it into, let's discover the best way. So the first thing he did was make the target clear. And how do we measure it? And he put a little whiteboard in the coffee area. And then they talked about, what are we going to do? What are the activities we're going to try? They started running experiments. And they figured out together how to learn together to say, identify people who knew different languages, how to plug the restaurant and all this thing. And guess what? The employees were super happy because now they knew what they were being measured at, and they could see that at every change they made the numbers go up higher. They started making videos themselves to train each other how to do it. So now they're all learning together. So that's structure for discovery, not just like go do what I told you with this myriad of stuff coming through. And he made enough money in that I don't like way more than paid for his MIT EMBA education. So, and I'll go back to the problem. There's a story around the problem. This is a factory one. A lot of the stories are factory because that's mostly my experience, but this works in intellectual work, which is where we've been mostly working for 15 years. So the guy was running a paper factory, and they were making corrugated cardboard, and they were having paper losses, like damaged paper, which is like, a huge piece on their balance sheet. So they had just spent like $1 million, I forget the numbers, like $1 million buying all this new equipment, and the losses went up.
Yeah.
So we told him he has to do a project as executive MBA student. So he said, you have to go on the shop floor and watch what's happening. He goes like, no, Don, I've done that all my life. Like, if you want to pass the course, you got to do it. So he goes down and takes a walk on the floor. And all of a sudden, he's watching more carefully. All of a sudden, the main machine shuts down. The main machine doing the corrugated piece shuts down. And he asked his employees, hey, why'd that shut down? Well, boss, we always shut down at 11:30 for half an hour. Now, this is a piece of continuously running equipment, which does not want to stop. Whenever you stop and start it, you have a whole bunch of trouble. Yeah. And plus, that's the main way they make their money. So he finds out that 10 years before, this is in South America somewhere, 10 years before, the electric grid was unsteady, and the government asked them to shut off during peak hours for a half hour to keep that was 10 years ago. They had built power plants, everything was stable, but that practice remained. So immediately, because he must have walked by there like 1,000 times and never noticed it before.
Right.
So the other thing he found was so they got the machine running, they spread out the lunch breaks, and they keep the machine running. The other thing they found out was the fork trucks. Every time they pick up a load of cardboard, the fork trucks were damaging like the 4 pieces of cardboard on the bottom. They changed the fork trucks, but he would never know that from sitting in his office. So again, his first thing was, well, we need new technology or we need training. Wrong. You're wrong. Go find out that's the solution. Go find out what the problem is. So I think he spent less than $50,000 fixing things and got a return of almost over $250,000 right away. So it's huge.
So much of these principles apply to processes. And I think when you're in the financial services industry, you don't really think about processes. But reading your book really hit home for me. I spent most of my career in finance working on a fixed income sales and trading floor. And every single year, management comes out and they say, hey, we want more market share, right? And there's this fundamental tension between sales and trading, right? Sales says, okay, well, we want more clients to do business. And trading says, but we want to make more money. Because guess what? None of us get paid if the trading desk doesn't make any money. But salespeople are judged by their market share, right? So every single year, since time immemorial, trading desk budgets go up every year, right? Without asking, well, why? Like, you're going to be judged off this metric. Why is this metric higher than the year before? Do you have the justification for it, et cetera, et cetera? But also, hey, we're going to build market share. Well, how do you build market share? It's always salespeople saying, you need to make tighter markets. You need to lower the margin that you're charging, right? So it becomes this insane feedback loop, right? Of like, well, we need to make more money. How? By charging less money, but whatever, right? So it's the same conversation that's been going on trading floors since the dawn of time. And it's like, when I read your book, what I was thinking is no one's stopping to ask the question of, well, what's the process that not how much money are the traders charging in bid offer, but what's sales' process, right? When you're sales and you come in the morning, what's your checklist? How are you communicating with your clients? What are you doing? And you said something in the book, which if you look at your process and part of it doesn't embarrass you, you're not looking closely enough. And that hit home so well. Because I also want to talk about this principle of firefighting, and I'd love if you could explain that. What ends up happening so often is you get in these roles that are super fast-paced, super high pressure. Not just we need to turn this company around over the next 5 years, but I need to get in every single day and do this job in this really fast-paced, high-intensity market-based role too. And it's, okay, but what is my system? What is my process? And how am I doing that? Am I just responding to the thing that's flashing red right now because I have to, because that's what I'm paid to do? Or am I taking a step back and saying, am I sticking to the plan? Am I going down the checklist every day of the things that over time will generate that ultimate result that I want?
Right. 2 things I want to mention before I talk about the firefighters. One is that although my background is manufacturing, the things that I come across have a certain pattern. So the thing you talked about between trading and market share, the analog to that in manufacturing is a salesperson that says to the factory guys, why don't you make what we sell? And the factory guy saying, why don't you sell what we make?
Exactly.
Like there's a place in between. You guys need to come to agreement what that trade-off is and then lock arms and talk to both groups so they're not fighting each other constantly.
Yeah.
But anyway, there's always those constant tensions in the group. The other thing is, it's not just the process, because if you say the process to people, they think they go look at a piece of paper and see what the process is. There's one process that's written down. There's another one that people are actually doing.
Yeah.
Oh, by the
And
way,
that's the
in
one
our
we have to
industry,
go
no one
see.
even writes down the process. There is
Right,
no
so
manual.
There
right?
is a process. It's just in
Exactly.
people's heads, and it's
Heads.
totally random. So we go,
Yeah.
Jennifer, let me see what you're doing. No, don't just tell me. Show me pull down the menu on what you're doing and show me. And like, oh yeah, I forgot to tell you, there's only 3 menu items on this pull down list, but I have 5 choices. So I just make up stuff on my own spreadsheet. Like, what?
Yeah.
So that's when you go actually watch the work moving, then you get to this piece. If you're not embarrassed by what you see, then you're not looking closely enough. And our framework hinges on 2 things. One is that the organization is made up of people, not departments, not processes, not computer systems. It's made up of people, and work moves from one person to another. And if you want to learn what's really happening, you have to take one piece of work and watch it go through those individual people and see what's really happening. Then you're going to see all the stupid, easy stuff that you can fix to put 30% on the bottom line really fast.
It's so interesting because, you were talking about like, what is the actual process? And there was that example in the book where you were talking about Broad Institute, where, there was the process that there should have been, but then it turned out that what ultimately happened is everyone would always jump the line. So they would get a sample. I think it was like from the COVID test, they would get a COVID sample, and then it would come in, and every single person to fast track their results, that every single thing would be like an emergency. And when Jen and I read that, we were thinking about ourselves because, of course, but like in our business, it's basically the 2 of us. And so we're getting emails all the time. We're getting social media DMs all the time. We're trying to put out like a podcast. We're trying to schedule a podcast, do questions and all this stuff. And everything becomes an emergency. So if we're trying to actually do something, nothing ever gets done because we're constantly, to your point, in this like fight or flight mode, constantly putting out fires. And so this was, I think, especially for us, why this was so, I don't want to say revolutionary, but it was like, holy crap, like we have to actually make sure that we are prioritizing the things that are essential. I mean, not everything is a fire. And so anyway, I just wanted to really hammer home that I think struck such a chord with us, because I mean, and it goes back to just like, when you're starting something out and you're small and you're scrappy and you're trying to do it all, that's one thing. But we've always wanted to like be the best that we can be now, even though it's actually hamstringing us, because then it's preventing us from actually being more efficient as we get bigger. So
you got one more big idea, one more new client, and you just keep throwing that in. So the trick is you have to figure out what your core work is and protect it. So this all started from Harley. Harley almost went out of business in 1985. And in order to save the company, people were doing anything they could, both the union and the salary people. So if the assembly line needed parts in York, Pennsylvania, and the designer had one on his desk in Milwaukee, the designer got on a plane with the parts in a suitcase and flew out there. Wow. And so those people saved the company, both union and salary people. The people that did those efforts saved the company because it was a huge crisis. The behavior got rewarded, and it became the culture. And so now people will like cut corners and rush things and they get rewarded. But the people are trying to keep the engine, the basic flow of the factory and the design stuff going and IT going. They got no love. So we start calling them firefighting arsonists out of the best intentions to like serve the customer right now. Let's go do it. They neglected to build up the capability of the base company. And so a lot of companies get in this position because they're successful. And all of a sudden, demand outstrips how fast they can produce. And so what they do is now they have to expedite. Oh, an important customer came. We can't put them at the end of the line. And as soon as you put that first customer up there, everyone else gets slower.
Yep.
It's okay in an emergency, but what you got to do with it is to figure out, why are we having to do that? And how can we expand our capability and capacity so that things can move through more quickly? Because
that's exactly right.
Like you would never interrupt a pilot when he's landing the plane. You would never interrupt a surgeon when she's doing open heart surgery. Everyone knows that. But we'll take intellectual workers, interrupt them all day long. Can you do this? Can you do this? Good as me. When they're trying to do this complicated work. And you can't see the productivity, but they've measured it like 30, 40% of the productivity is lost when you interrupt people to do that. Sometimes it takes them 15, 20 minutes just from switching apps to recover what they were doing, get back where they were and thinking about this. So we want to figure out why the system can't handle the demand, and then expediting becomes the system instead, and that's the firefighting arsonist Again, sometimes you need to do it to recover, but when it becomes the system, then you're in big trouble.
Correct. It becomes the de facto system. And I couldn't help thinking about investment banks when I was reading this chapter, because we literally work in an industry where it is the norm to be working all weekend.
I'm laughing. I'm just laughing because I've seen this a million times, not because it's funny.
insane
It's terrible. It's
that you're
abusive.
working
Yeah.
on- It is,
Right.
and it's rewarded, right? It's
Of course.
You're the hustler. You're grinding because you were up till 3 a.m, and that's glorified. Why were you up till 3 a.m? What is happening at 3 a.m? Unless the deal is being announced tomorrow. There is, and then there is a reason. Okay, like, listen, we got to be up till 3 a.m. It's crunch time. It's the night before, but it's not the night before the deal every single night, 252 days a year, right? Like that's not physically possible. So
I have one finance story for you. We were teaching in the executive MBA at Sloan. And these people are going like weekends, every third weekend or something. Plus they have a full-time big job. It's people in their late 30s to early 50s. They got big jobs and they're doing their job and taking MIT MBA at the same time. It's a lot of stress. And they're doing finance, all this other stuff. One guy comes to me and says, Don, I saw your class. So you taught me the operational excellence thing. He says, maybe you can help me. And what he's got is, I don't know exactly. You guys will know what this is. He gets these funds that last like 5 years and then they go out. So he has to raise the money to bed this fund. And then it goes out and needs to find something else for people to invest in. So it's a constant churning of people going out and back into deals. You know what I'm talking about? Okay, so
this is like the private equity. This is what private equity firms do. They
I don't
go
know.
out and they fundraise, and then once they get to like 5 years and they deploy the capital, then they need to actually start raising their next fund, and then their next.
That's what it was. Now I'm not a finance person, but I understand what he was up against. And he said the guy that's doing this, he won't tell me what's going on, and then everything's like coming at the last minute, and he's always missing his target. And I said, here's what you do. I went into a room with a whiteboard and I drew like, how does this work in phases or by time? He says, well, it's phases, but it's kind of time based. He says, like, we contact people, then we get them on the hook, and then they're hooked, and then they have the money. I said, ask him to write those 5 phases on the board and take a little stupid yellow Post-it note, put the name of the person, the stage they're in, how much money he thinks he's going to get, and show what's on the board. Now you can see if he's making enough progress day in and day out. You don't have to wait till the end to see. And he comes back about 2 weeks later. He said, Don, I did that. And he has nothing on the board. It was all kind of this chatter, just telling stories. Oh, yeah, I'm doing this. Don't worry. But when he had to show nothing, he said he got rid of that guy and he tripled the amount of money he was raising by using that simple little visual management tool through the company. Tripled the amount of money he was raising. Because now they could see, oh, here, we need work here. We have enough here. It's moved. Because, people will fall out at every stage. I have enough here to get the money, or I don't. Now they knew where to put their scarce resources of attention.
Yeah, it's like the funnel. Yeah, you gotta.
Exactly.
Yep.
Exactly.
I was going to say one other thing. I mean, it's actually ironic because in banking, there is a term called a fire drill. So you'd call it the firefighting arsonist. Like bankers are always talking about how like, oh, there's this fire drill. But it's like, to Jen's point, there's a fire drill like all the time. There shouldn't be a fire drill.
By the way, it's called a fire drill, not a fire, right?
Yeah,
and
that's
so
also fair. Yeah.
Right? It's hurry up and do something with no actual.
That's such a good point. I never thought of that.
Exactly.
It's the drill. It's not even like the actual fire.
It's everyone driving themselves insane and pulling themselves away from their work for something that isn't going to materialize in a closed deal, paycheck.
That is
trade,
wild
whatever it is.
that's the term that's used. Oh my God. That just like dawned on me.
That's why
So
it's
think
used.
about-
It's like, oh, we're going to go through this fire drill because it's pointless. It's the pointlessness that's embedded in
I never
them.
got the pointless.
It's so
I
abusive.
was like thinking the chaos.
This stuff is so. And the reason I still am doing this in my 70s is not it fixes companies, make them work better, and they put points on the board and make a lot of money. The reason I still do it is because the way these big organizations work is so abusive to employees. And when you fix it, people actually love what they do. They put their heart and soul into it. They feel better about it. And you put points on the board. So I think that increase of morale, people having some skin in the game and getting connected with what they do is really what it's about. One metaphor I want to use, like think of an orchestra. You go to the opera or whatever in New York and you're sitting there and the musicians are all tuning up. They're all playing all kinds of notes. They're all working really hard, but it sounds like crap.
A mess.
It's just noise, right?
Yeah.
Okay, so what happens when the conductor taps on the board and they start playing the single sheet of music?
Yeah.
And you notice that it's music, but if you watch an individual musician, like the violins are not always playing all the time.
Yeah.
Sometimes they're quiet. So I think what we do is help managers and people in the mud figure out how to get the system to flow, and not with the belief that if everyone's working hard and busy, then that's productivity. We want to get the system productive by having people do the right thing at the right time based on the work flowing through.
Well, and just to echo what you're saying, I think one of the key, or rather most common critiques of when private equity comes in to run a business, it's okay, they're just going to gut everyone. They're going to take the hardest working people who are the heart and soul of this company, and they're going to cut that bottom line in order to maximize profits. And listen, sometimes that does happen. But I think so often, and this can happen in organizations that aren't owned by private equity as well all the time, but you get the people who are doing the day-to-day work, and they're like, those managers don't know anything. They're just a stuffed suit up there, taking all the credit for what we do. We're the ones doing all the work. And you get that bottom-up resentment and distrust. But you also have that at the top levels, right? You have the brass that comes in and they say, this company should be doing this. We have this plan to get it here. Like, who are all these lazy people who are just running out the clock every day, not doing work? They don't look busy. They don't whatever. And so both sides, there's this resentment that goes up and down the chain simultaneously.
And the thing is, there are good people on both sides of that, Jen.
Yes.
There are good and evil people on both sides. Most people are good. They just don't know how to get those things connected to get everything moving. And I think that's what the framework for us has done.
But I think too, right, when you think about when it works, why does it work? Well, you get private equity managers who come in and they think like expert operators, right? So you can't just say, okay, well, these cash flows for this widget, when discounted back, should be worth more over time. It's, hey, we have this existing workforce. Where is their untapped potential? What can we do? What can we see with fresh eyes? And I think that's, everyone talks about AI is going to get rid of consultants. AI is going to get rid of all of this intellectual work, these white collar jobs. Well, AI doesn't have fresh eyes. I just saw a report that's like AI is really good at tricking you into thinking that it's thinking. And all it's really good at is reading large amounts of data and spitting it out to you in a way that makes you think it's thinking. Whereas humans can approach a problem with fresh eyes and say, hey, this looks weird. Why are you doing it this way? And just ask a dumb question. And 99 times out of 100, that solves the problem.
I also wonder too, how much of it is almost like the buy-in. I mean, we talk about it all the time. Like, people don't value things that are free. So it's like, cool, you can like put some stuff into AI and like say, what should I do? I think it's a lot harder for people to actually then implement change. By the way, I mean, eventually, sure, I'm sure that like it'll be able to do video and you'll be able to analyze it. But like, I do think having, again, the people who are having the conversation, like, you know, for consultants actually going in, talking to people, figuring out what the process is, having people give their own input, which, you know, I like, to your point, when you were teaching this class, and I'm not sure how much of that is also part of it, like, you have these students who are part of the organization who are then figuring out, oh my God, like, this is the thing that's causing these problems. And wow, we can fix this and we can make change. And, you know, when Jen came to me after reading the book, right, there was this buy-in that we both had about it. And I do wonder, like, you know, if you have, I mean, but that's because it's like a 2-person organization. When you have like a much bigger organization, it's like you have whatever, Bob in accounting or the XYZ person on the floor, on the, you know, Harley-Davidson floor, who's like, well, this is how I do it. This is how I've always done it. I've done this for 20 years. Like, you're going to tell me AI is going to tell me I need to do XYZ thing versus like actually getting them involved. So I don't know. I like reading the book. It actually made me feel like, wow, people that want to, you know, sound the death knell for consultants. And I'm like, honestly, I actually think that that's probably not going away anytime soon, because I don't think that AI is going to get the change that you would see also having put money into like implementing change and having the buy-in from the whole organization.
Right. So the mistake I think people make thinking about AI is they use it to replace people instead of enhance people. Mm-hmm. There's no question that it's more productive used properly. I have a son-in-law who's in pharma and he does AI and drug discovery. He's a PhD organic chemist. And he says it's like having a grad student. I can ask it a question, get me information that's out there, that's available. He can do it a lot faster and cheaper than a grad student. But it can't tell me what to do with it. And it can't tell me what's going on now. It only knows what you tell it. And it's just looking for patterns. It doesn't know if the pattern is right or wrong. It's just actually choosing the next word from all that data. So it's basically automating intellectual work,
Yeah.
but it can't create. Just I think the lesson we learned in manufacturing with robots was if you have a process that's got a lot of variation and it takes a lot of people doing little tricks and things to make it work because the design is a little bit iffy. If you try to automate that without incorporating it, all the little tricks that people have, it's not going to work. First, you have to get the human system working so it's like flawless because that robot's just going to do what you tell it to do.
Yep.
It's not going to be able to make any adjustments. So I think it's going to work for intellectual work that can be automated, but it's in service to people thinking. And I think when you reverse that, then people are they're going to make a lot of mistakes with AI.
Mm-hmm.
Yeah, no, I totally agree. And I think one of the key takeaways from your book was don't make big investments in technology.
Correct.
Right? Because if you make a big investment in technology, all it's going to do is run deeper grooves of the bad patterns that are already in place. It's not going to disrupt those patterns. Make small investments and use the scientific method to test the hypothesis that, and hey, listen, if you make a small investment and that delivers a big change, okay, then you can up the investment, right?
Exactly.
But don't overhaul everything altogether.
Exactly. We had a client that wanted us to come in because they were going to do a big expansion. He said, let us come in and help you. That expansion was postponed for 6 years because we kept helping them fix all the stuff that was wrong and get more output and more productivity from the group. And then when they did do the expansion, it was much smaller and much more targeted and based on a lot better design of the work than they had before. Exactly like you said, Jen. Go experiment. Go see what's wrong. A lot of times it's not the automation, it's the human system behind it.
Well, it's interesting because there was this article recently about how a lot of firms are not seeing return on their AI investment. And I think part of the reason is like they're trying to spend all this money, but and especially like, large banks or whatever, because you could spend like $20 a month on like OpenAI and start to like incorporate it and actually like teach people how to use it and actually start versus like trying to like build the whole infrastructure yourself. Like why, And also to your point, I also think that now we're at this like inflection point where things are going to be improving so quickly that a lot of times if you are making these massive investments, I do think it's going to like be outdated in like a year, but that's my 2 cents.
Yeah.
So
I think that it's part of our culture in the US to do these big things really fast, but in China, they're actually approaching it a little differently. They are deploying it in much smaller pieces to automate from the ground up things they know about. And I think they're going to build their way to a much stronger system that way. Nelson Repenning, my co-author, has this example from GM. In the early 80s, the CEO said, every time the union asked for $1 more raise, we think of buying 500 robots to put them out of business. And they did. They actually installed all these robots in a factory and they could never get it to work. We have automated factories now, but the way people did it was step by step and learning, making sure the humans were in charge and basically simplifying every task and making it very repeatable and then automating it. That's a long road and a lot of work. So I think the same thing is going to happen with AI. All this big stuff's going to blow away, but the people who stick with it and learn from it and do it step by step are going to be successful over the long term.
So, I mean, at the core of what this model is, this dynamic model, what I took away, and correct me if I'm wrong, was really just, it doesn't serve you as a business to have a prescriptive way of doing things that you stick to at any given point in time. This dynamic concept is that, hey, the people doing the work should always be open to changing that work, examining it, et cetera, et cetera. And the people managing shouldn't be thinking of themselves as, oh, it's just my job to hit these big targets and think these big lofty goals. That I need to think at the granular level, and people who are doing the work at the granular level need to think like managers, right? It's this up and down. And correct me if I'm wrong or missing anything in this, but also what I took away from it was what we see today. Reading this book felt like a yearning for days past where people who worked for a corporation felt that ownership mentality, right? When we talk all the time about these jobs in finance, we get pushback from our social media community that says, well, this company doesn't care about me. I'm just another cog in the wheel. I'm just another employee. And I think there is a very valid reason why people feel that way this day and age, especially post-COVID in the last 5 years, as people feel more disconnected than ever. But I'm curious if you've seen, through this method being implemented at companies, a shift in terms of loyalty, in terms of like worker happiness, in terms of longevity.
Absolutely. A couple of things. One is finance is a fast moving business and it's always going to have pressure in it. But I think it's way over the top in most places. When we start small and actually fix the work so that people like it better, they can do it better, and they have a voice in like fixing the problems, and the managers come in and guide those. Neither side knows the whole answer. People know the problems, but the managers have the resources and the expertise to fix it the right way if they're smart. So when that partnership is active and constant daily, doing all these small changes to make the work better, not only do you get better results, but the people love their work more because they can actually they practice their profession, and they love the company because they go like, I learned something, I did something. Mm-hmm. Like who doesn't? Yeah, I worked hard. Okay, I worked 12 hours because I'm in finance, but we did something. Look what we did. Like think about people in a crisis, in a huge crisis, no matter how bad it is, like 9/11. When they come away from that, they like feel like this was the most horrible thing I've lived through. But we worked together and we solved all these problems and we made a difference. Mm-hmm. Then they go back to the work, their old jobs, and they just sit in stupid meetings and be told stupid rules. So what's happening when people work in those crises? They get together face to face. The target is very clear. It pushes everything, all the little bullshit out of the way. Mm-hmm. They talk about stuff. They run small experiments. They don't plan like, oh, go do 50 experiments. Like, let's do this experiment, find out what happened tomorrow, and then we'll change.
Yep.
So how do you take that experience and put it at a slow burn in a big organization? So everyone is constantly challenging every assumption, constantly doing small experiments to learn from, not that break the company, but like, oh, we fell off, pull it back. Or what did we learn? And create this ocean of innovation and experimentation. Of course, people love that. Of course they do.
Mm-hmm. Yeah. Well, I think my biggest takeaway from the entire book was 2 graphs. One showed what happens when you rush everything to the front of the priority line. You act like that firefighting arsonist, right? And you are constantly in that state of high urgency. And right. You showed a graph where, hopefully my fingers are in the right direction, where there's an initial bump higher.
Better before worse. Yeah.
Over time, it drops down. And over the long run, your business gets worse and worse and worse. And the prescriptive, effectively, solution by implementing these 5 principles was make your business worse, and you get that immediately drop off in quality, that drop off in production, whatever it is, as you look inwards and figure out, okay, what am I going to do internally to solve these problems, and what are the problems and all that fun stuff? Let's get processes in place. But then over the long term, your business gets better and better and better, right? That worse before better metric. And I think that that's something that doesn't just apply to business. It really applies to people. I think that that is a
exactly right.
We are so trained for this like dopamine hit, this instant gratification that you get from being the hero, from solving the problem really quickly, right? But you solve one problem really quickly and you have 10 more behind it, and you're out of energy and you're tired and you're depleted and blah, blah, blah. You get worse, right?
You've actually added to the problems.
Yes.
So
yes.
My colleague is a MIT PhD, and this is actually how he got it. Part of his main work. It's called the capability trap, which is we're going to do this big program, right? And it's going to promise this big gain. And maybe it does, but the real dip happens because implementing this big change causes the worse before better. Yeah. So in that big dip, people give up on that change, even though if they played it out, it would work. And the other thing is like the better before worse. Like Kristen told me I have to improve the maintenance cost next year by 30%. Well, I fixed it yesterday. I just fired 50% of the maintenance people. Look, our maintenance expenses are cut in half. Yeah. So that's the better before worse. So this was his main work of explaining why organizations don't take on these things that are proven methods, because they turn them into these huge programs. And what our method does is say, let's run an experiment. We'll have a tiny little bit of worse and then some better. And then we're going to invest that in a tiny little, so we can actually see this little curve of always getting better because we're taking the worst in small bites and actually proving the point, putting points on the board in these small pieces.
Yeah, it's so interesting because last week, Donald Trump had tweeted about getting rid of quarterly earnings. And it was something that my initial reaction was like, what now? And then, as I thought about it, I was like, actually, okay, this might not be that bad. But I will say what's so interesting, because one of the almost arguments for going private and companies being bought by private equity firms and almost going quiet and not being able to be seen by the public is that you can institute these changes and not almost give up when things get worse. Cause you can have a short-term benefit, I cut costs by 30% because I fired 30% of the maintenance people. Oh shoot, I need those people actually to like long-term benefit me. So there is the argument for having almost like doing things in private. It's like again, celebrity like goes and gets like a facelift because they don't want to be seen in the public. But anyway, so the argument of like doing things and like being able to almost like have the stomach for that short-term hit, and again, out of the spotlight of the public. But I will say, back to the quarterly earnings things, I'm not really sure how much going from 4 times a year to 2 times a year gives companies the oomph to be like, oh, okay, now I'm out of the spotlight. Like, no, I still think 6 months is still not enough time, but my 2 cents.
You made the analogy though of the election cycle, right?
Yeah.
Part of one of the biggest critiques of the election cycle is that, okay, you have like 5 minutes to do stuff in office and then you're focused on getting reelected, right?
Yeah.
Whereas if you had a longer runway, and obviously there's critiques with that as well, right? Because then you have someone in office for a really long time and they're a bad actor, that's a problem.
So
but yeah.
Because having I would do it a little bit differently, because I'm not sure the motivation for having quarterly reporting cut in half is pure. Some of it may be hiding, but so I think 2 things. One is we need better reporting, and 2, we need better behavior on managers, which is they need to think long term so they can continually get good quarterly results, and not this like, oh, we have to pull off this like big miracle and then whoa, what am I going to do next quarter? And it turns into this firefighting thing. I think it's the behavior is what's wrong, not the report. I think we actually need better, more transparent reporting.
I want to actually just like put a exclamation mark on that. It's really funny. So I'm building out this like financial modeling course. And so I spent yesterday essentially creating a financial model we're using Fox because our case company is like Succession. So Waystar Royco, and the closest comp is Fox. So I was looking through their 10K, and I was like going to CapIQ and like downloading their financials. And, one of the things is like, even on the income statement, like there's just no sign convention. So you're like, is this an income? Is this an expense? And then I tried to like use like the downloaded financials that they published via Excel with the SEC. And it's like, it literally has open paren, close paren, but like it doesn't function as a number in the Excel. And I was like, what the hell is this? I actually ended up using ChatGPT, and I was like, ChatGPT, create me these financials so that I can actually like understand what the hell they're trying to say. P.S. by the way, ChatGPT got a lot of things wrong, which I was able to figure out. But like the point of this whole thing is like, if I've literally taught this and I understand how these financials work, and I've been doing this for almost 20 years at this point. And even for me, I was having a hard time being like, wait, what are you trying to say here? I don't know if this number that you have is an income or an expense. Like the way that it's written is so confusing. Anyway, so that's just my little whatever rant on that. So sorry, back one more thing, because we had you go through the 5 principles. I feel like we got through 1 and 2. We had solve the right problem was number 1, structure for discovery number 2. Structure for discovery.
A lot of times we build a plan and then we measure people on executing the plan. And if you don't execute the plan correctly, or if the results don't come, we blame you. Okay, in your performance review or something. But no one actually goes to look to see if the plan is the right thing to do. So we put together 4 elements. It's like, what's the target and the supporting metrics behind it? What are the metrics and the supporting metrics behind it so that you're doing the right thing? Like, for instance, you can't just say go faster. You have to say go faster and don't raise the cost and don't lose the quality. Now I have to actually fix it instead of cut corners.
Yeah.
The third thing is I want to see the activities that you're going to do. I want to put them on the wall so we can look at them. Oh, Don, don't worry. I know how to do this. Are you questioning? No, I'm not questioning you, because if you know how to do it, just write it down on the wall. And then we begin to take this out of your head and make it visible so people can see it and check it. And then we can organize the activities to make them collective. And then we add another piece, which is a really quick feedback loop. So now we look at, what did you do last week? Did you do the activities? Did they produce the result? If they did, great. What can we learn from it to go faster? And if they didn't, what can we learn to go forward? And usually those problems, which a lot of leaders don't want to hear about, is like, do as I say. But those problems are really a crack in the wall where light's coming through to say, you have a problem here that if you go deep and understand it, you can actually innovate quickly and learn something. So it really focuses on discovery, not just implementation. That's number 2. The third one is connect the human chain, which is work moves through people, not through departments, not through software systems. It's only really people in their brains, especially in intellectual work, that are doing the work. So we have two chains. One, work goes, the way we draw it is horizontally as the work moves from person to person. And then the management chain is vertically. So when I need help or I need direction or get targets, all the decisions and problems, that works through the management chain. We can draw that vertically. And it works on the idea that we talked about before, which is that there's basically two kinds of work. There's huddles and handoffs. And when you mix those up, then you get chaos because you get emails flying back and forth when you should need a meeting, or you get endless meetings when you could just send an email. Yeah. And the same thing happens with managers. Managers mostly work in huddles, and there are two types. One is a schedule one, like a daily, weekly, monthly, quarterly meeting, a schedule. There's a set agenda. But the other one is one that's rarely used correctly, and that is event-based. And this is the fire alarm. When someone has trouble, they need to know who to call, when to call, and that person needs to respond right away, like a fire alarm. Mm-hmm. Like a trader, like, oh, I lost $500 million today. I'll make it up tomorrow. No, there should be a limit. It was like when you lose over $100 million, you would raise your hand. Even if you know the answer or the reason explainable, someone's going to come and talk to you, right? So we need to check.
On shoulder for $500K in a lot of banks, not $500K.
Okay, well, whatever. I didn't know nothing about this industry. So anyway.
I feel like historically there probably was not. And I think that's where those limits became, they started to get put in place because people were losing that kind of money. And it's like, oh, shoot. Yeah.
But we get people who say, just bring me solutions, not problems. It's your job. Managers don't take enough ownership over creating a system that works. And when things are out of line, people need to ask for help, not because they're right or wrong. It's about the customer and making work move and continue to move and protecting that flow of work. If I made a mistake, okay, I make mistakes, but I'm going to get help when I make one so it doesn't affect the thing. If it's a supplier that makes a mistake, okay, we can talk about that later. Like when you pull a fire alarm, everyone knows when to pull the fire alarm and they know who's going to come. It isn't like a signal goes out to like all y'all in New York City and Manhattan, like anybody who's like kind of sitting around not doing something today, come to Kristen's workplace because it's on fire. No, it goes to a certain place that's trained to respond. And that's the way we need to make managers behave because those cracks in the wall are places where we can learn and innovate, but we treat it as bad because we blame it on people instead of blaming it on the work system and going and fix the design. So that's connect the human chain, those two things. Next one is regulate for flow. This one's easy. You put too many cars on the highway, what happens? You get a freaking traffic jam. And when I put too much work in the system, then we have expediting and task switching. One, your productivity drops at least by 30% immediately. And two, the predictability of when any one certain car or task is going to go through goes way out the window. Because the ones that get expedited are going to go through really fast. But there's always going to be a long tail of that delivery. But if you control the traffic on the highway and optimize the flow, you can pretty much predict when they're going to come and you optimize the flow. But every manager, like the two of you, is like, there's just one more great idea I got. It all comes from good intention. We can do one more without paying attention to the capacity, the natural capacity of the system and growing it to meet the business. So that's number 4. And the 5th one is visualize the work. Imagine if air traffic controllers only got a spreadsheet with latitude and longitude coordinates of where the planes were. How in the hell would they tell them what to do? They have a digital twin of what's happening in the air. Yeah. It's not just the metrics, like this one's on time, 32% on time. No, they can actually see where the planes are. And so that visualness helps them manage the whole system. And so when we talk about visualize the work, it's not just put the scorecards and the metrics and the milestones on the wall. We want to see like, where are the deals in the stages? Who's got them? Are they moving or not? Are there too many? Are there too few? Is there probably need to adjust so we can quickly assess the situation together and apply the right resources to keep that flow going? And there's a whole thing about visual management, but especially in intellectual work. I mean, this was piloted in factories with Toyota and other companies and all these kind of visual things, because you can see when an assembly line shuts down, everyone knows. Yeah. But when your project goes south or your deal goes south, who knows? Yeah. Until you decide to tell, and you wait as long as you possibly can because you want to fix it, because you don't want to be bad, instead of everyone saying, hey, there's a problem with Jennifer, let's go help her. There's a trick to visualizing the flow of work and managing it. It's so unbelievably powerful. It's way more powerful than it ever was in factories because intellectual work is infinitely compressible. If I get a stamping press, no matter how much I optimize it, it's still got to press the metal. We can make intellectual work almost totally disappear.
Yeah.
So those are the 5.
I love this. I did want to ask a personal question because there's been obviously this like huge pushback against going to college. And I actually thought it was really interesting. You went from high school into a factory. I know you ultimately did night school, but it's interesting, right? You have a daughter who's like brilliant, I think what, Caltech, like PhD, whatever. And so I'm just so curious, if you could go back in time, would you have decided to go to college before going to the factory / like, you know, if your grandson, right? Like, would you tell him to go to college or actually go into the field first? And I mean, what do you think the benefit or the trade-offs are of almost like that actual practical work? So it's so interesting. Also, your partner, right? It was the ivory tower, PhD, MIT guy, and you're the practical person. So I'm curious kind of like what your perspective is. Clearly you have the intellect, but like, would you go back and have gone to college first? Or like, what was your feeling on that?
Well, a couple, maybe even contradictory thoughts. One is education is super important, and we need smart people trained in smart things because it's a complicated world. The science is getting more and more complicated, and we need those people. But people are not the same. I grew up in the 60s, and it was a time of the civil rights movement, Vietnam, and a lot of kids, including me, were really messed up. I mean, just totally conflicted, and there was a lot of turmoil. And plus, my family loved to drink. I mean, I don't think anyone was an alcoholic, but we certainly were alcohol abusers when I was a kid. And so I was just not emotionally ready to go to college. And I went to work in factories, and I turned out that I actually loved it, Kristen, because I got in factories, I could solve problems and figured out that I was a natural problem solver. And that's what made my career. So I think the path is different. My daughter's tremendously successful, is now chief of staff in a big pharma company with a PhD in organic chemistry, worked in a startup and blah, blah, blah. My son's had a different path. He's smart enough to get into management, but he hates management. He tells like, he's not good at playing the political game. Like he'll go tell the CFO, you've got the wrong strategy for this. Here's all the numbers. And he's right. But the CFO hates him for telling him that he's wrong and fires him, or gets rid of him. So, but now he's wants to be a fireman, which he's a CrossFit guy and 6'4" and a weightlifter, and he loves it. I think he'll be way better as a fireman. So I think we need to have more respect for the people that work with their hands and actually know how to do stuff and fix stuff.
Yeah.
But we need both. For me, it's not an either or world. It's a both and. We need both. We need to work together. We need a place for everybody to apply their skill. Not everyone's going to be a millionaire or billionaire. Some people are just going to make normal wages, but they need respectful work. We need to thank them for coming and fixing our plumbing or electrical stuff or whatever.
I love that. Yeah. And I agree 100%. And again, the joke's on also like the intellectual work, because that's where again, AI is coming first. But anyway, this has been such a good conversation. Again, as I said, the book has definitely helped us in our business. So I want to thank you for that. And so the name of the book is There's Gotta Be a Better Way. You can get it on Amazon. You can get it on Audible. I actually did a combination of Audible and physical books. Jen is a speed reader. I mean, it's actually wild. She's like, yeah, and then like within the course of like 2 hours, she's like read the whole book. It takes me a lot longer. So anyway, but it's a really, really great read. I highly recommend it.
It's a fast read, guys. Yeah. You are not going to be bogged down. It's very well organized, and it's all done through storytelling. So, I mean, it goes from the factory floor at Harley-Davidson to casinos in Las Vegas to labs in Cambridge, Massachusetts. There's so many different perspectives, and I think it's going to fly by. I read it in 2 days. Casually. So I just absolutely loved it. And again, we are implementing these strategies in our own business and seeing results within 48 hours. That is shocking to me.
This is true.
There's no like self-help, business, diet book, whatever you could read.
And for the record, this is not sponsored. This is not sponsored. This is just like our actual feelings on that. So
it's passion.
Anyway, yeah. Well, thank you
I
so
didn't
much,
pay
Don.
you to say that.
No, this is actual. Like,
well, write us a good review. Okay.
We will. Well, thank you so much. And we will drop your info in the description of the podcast. And so thank you so much. And we'll see all you guys next time.
Thanks for having me. It was really fun.